Good morning and welcome to today's meeting of the CFTC's Agricultural Advisory Committee. As the designated federal officer, I hereby call this meeting to order. I would like to extend a warm welcome to Chairman Behnam, Commissioner Goldsmith-Romero, and Commissioner Mersinger, and thank them for joining today's meeting. Thank you to all the members of the committee and the guest speakers for their time today. To begin the meeting, we are pleased to first recognize Chairman Behnam for his opening remarks, followed by the commissioners. Chairman Behnam.
Thanks, Swati. Good morning to everyone. Welcome to Washington. Big week here. We were busy yesterday, but I'm sure for everyone, we appreciate you guys traveling to Washington. It means a lot. And I'll be very brief. We have a big morning and sort of reflecting on where we've been for 2023. Just talking to Scott and Swati, we had the meeting in April, I had another meeting in July. And that was sort of my vision probably about a year ago this time, thinking about what we would do for 2023. And I think we've covered a lot of topics. We've tried to include as much as possible in terms of what the committee has wanted to address. I think we have a lot of work to do, obviously today, but tomorrow as well. And just, important issues about what we're seeing in our markets and how it affects and impacts all of you, ag end users, commercials, and sort of market infrastructure participants. Obviously, a lot going on in the world geopolitically that is directly impacting agricultural markets. So I think we have a serious and a big responsibility, I think, as market regulators and our participants to think about these issues so that ultimately we could keep the ag economy and the ag value chain healthy, costs low, and continuing to feed the world. So a lot to do. I think a lot of uncertainty still in the marketplace, but I really do appreciate all of your engagement and working with us at the commission. I was in Dallas a few weeks ago, gave a brief speech about livestock and cattle markets, but also we announced the K-State event, which we're going to have in April of next year. So that'll probably be the next time we get together, I think, both as an advisory committee meeting, but it'll be a broader agricultural conference, which many of you know and have attended in the past. This will be the third one, but the first since COVID. So very excited to bring that back. We found that conference to be really an exceptional opportunity for the commission to sort of go out into the field, to get to Kansas City, which we have an office there, which means a lot for us and our staff in that office as well. But really bringing people together from all parts of the country, working with K-State, which is a great partner to think about ag markets and risk management, and we're really thinking about a great day and a half or so of discussions and panels and just being together and catching up. So we will get through the holidays, take a little bit of a rest, but as we get into the new year, certainly want any feedback from all of you as we shape and curate that agenda over the next couple months, because I think it's another good opportunity for us to invite other policymakers, obviously stakeholders like yourselves, but anyone who's involved in this, in the value chain, so that we can think about these issues and start to resolve some of the issues. So with that, looking forward to today. I do want to thank Scott Herndon and Swati again. As you guys all know, this is how the committee works, is these two individuals. Everyone at the commission who's helped us get to today. Like I said, we had a busy day yesterday, but constantly turning over and looking forward to the discussion this morning. So Swati, I'll turn it back to you. Thanks.
Thank you, Chairman Behnam. Commissioner Goldsmith-Romero.
Good morning. I want to just echo the thanks for you coming here. I really appreciate it. Thank you for your service. Thank you, Chairman. Thank you, Swati and Scott, for your service. It has been a big week for the commission. I think we saved the best for last, which is pretty nice. I want to echo something the Chairman said. So I've really benefited from hearing directly from you, directly from our ag sector, not just the challenges that you face, but the pride you have in what you make, what you deliver, and all of your on-the-ground experiences has really helped. It's one thing to hear about transportation or labor issues, and it's another to be there watching that all of a sudden the train showed up super late, and they're trying to pull people in to fill it, and I was able to see that. It's also a situation where when we talk about input costs and labor costs, being on the ground and being able to see it is really helpful. But I really appreciate that people reach out, and we have these meetings in Washington too. and then also on Zoom, because I do listen, I do input that. I encourage you to reach out to me. I want to start 2024 hearing from everyone, particularly in the ag sector, about what the issues are so we can plan for the next year. And I also, not just the challenges, but the excitement about what you're doing. It's fascinating to me to go in there and actually, learn about sorting soybeans for Japanese customers that want like uniform color, and actually sit there with them in my hand and sort of understanding that. And I never knew there was so much to learn about oils. I know a lot more. Importantly, you really drive the economy, and I was at Treasury for 12 years, so I tend to look at things through the lens of how it relates to our economy. And so my highest priority has always been that these derivatives markets are working well, particularly for you. I think the derivatives markets can play a critical role in the economy too. We need to stabilize prices. We've got to deal with volatility, particularly as these geopolitical issues come up. So I think 2023, the derivatives markets have worked really well under some significant stresses. So I really look forward to these presentations about Ukraine and Russia and Ukraine and the other geopolitical events. We've been tracking, and I look every day at those wheat prices, and I really rely on our economists who do a good job of bringing other data in, whether it's from USDA or wherever, and we're making analysis. That is something we do every single day. I do not have a day where I do not do that. That is the start of my day. It's usually also in the afternoon, so it's twice a day for me, every day that I've been in this job. I never lose sight of that, and even when we have emerging issues or technology, you might hear speeches. My day-to-day work is monitoring those markets, and so I'd love to hear from you. Thank you for all of your service. I look forward to the presentations today.
Thank you, Commissioner Goldsmith-Romero. Commissioner Mersinger?
Good morning. I'm going to keep my remarks brief this morning because we do have a pretty packed agenda, but a really good agenda, and I think a lot of presentations that are going to be very helpful to the work we do here. I'll just mention I was actually home in South Dakota at the beginning of November and catching the tail end of corn and sunflower harvest. And it struck me, when you're not home for a while and you go back, the cost that goes into production agriculture. When you see the number of, a line of combines trying to get through these fields. I mean, I think my dad, he cut down the last row of corn at 3 a.m. Because they've got to get it out of the ground. They've got it, if there's weather coming or whatever, I mean, they will work through the night. And, it's the combines, it's the semis moving the grain. There is so much cost involved in production agriculture. And it's just a good reminder that our agriculture markets truly are used for hedging those costs and risks that are involved in production agriculture. So they have to work. The other thing I will say is, people may worry that, we spend more time thinking about, whether it's some of the financial markets or crypto or whatever. But if you need a reminder of what's truly important to this agency, I was recently before the Senate Agriculture Committee, and I would say 90% of the questions I was asked had to do with agriculture. So it is the most important thing that we do here. And that's why meetings like this are so important. So I'm going to turn it back to Swati, and thank you all for being here, and I'm looking forward to the presentations.
Thank you, Commissioner Mersinger. Before we begin today's presentations, I want to remind all participants in today's meeting to be mindful of when your microphone is muted and unmuted. Please make sure to mute your microphone when you are not speaking. After each presentation today, there will be a dialogue segment where members of the committee, the chairman, and commissioners will have the opportunity to provide comments or to ask questions. If you would like to speak, please turn your name hat to the right. If you are joining virtually, please use the raise hand function in Zoom. When called upon, please identify yourself and the organization that you represent on the committee. Scott, I'm going to now turn it over to you.
Thank you, Swati, and thank you, Chairman Behnam, Commissioner Goldsmith-Romero, and Commissioner Mersinger. I look forward to facilitating the discussion of members' perspectives to the AAC and working with AAC members to provide the Commission with feedback and recommendations that assist the agency in its oversight of our markets. To ensure that today's discussion is consistent with the AAC Charter, no determination of fact or policy shall be made by the AAC on behalf of the Commission. Determinations of action to be taken and policy to be expressed with respect to the reports and/or recommendations of the AAC shall be made solely by the Commission. Before we begin our first panel, we would like to do a roll call of the members and guest panelists so we have your attendance on the record. Swati will lead the roll call.
Thank you, Scott. AAC members, after I say your name and organization, please indicate that you are present. If you are joining virtually, please make sure your phone is not muted. Buddy Allen, American Cotton Shippers Association.
Present.
Joe Barker, National Council of Farmers Cooperatives.
Present.
Chris Betts, Michigan Agribusiness Association.
Present.
Robbie Boone, Farm Credit Council. Lane Carlson, Minneapolis Grain Exchange.
Present.
Robert Chesler, United Dairymen of Arizona.
Present.
Jerry Corcoran, Futures Industry Association.
Present.
Patrick Coyle, National Grain and Feed Association.
Present.
Edward Elfman, American Bankers Association.
Present.
Edward Gallagher, National Milk Producers Federation.
Present.
Harold Wohl, National Corn Growers Association. Thomas Hayden Jr., Commodity Markets Council.
Present.
Scott Herndon, Field to Market.
Present.
Thomas Hogan, Cocoa Merchants Association of America. Jared Hooker, American Soybean Association.
Present.
Brian Humphreys, National Pork Producers Council. Willis Kidd, Citadel.
Present.
Jeff Lloyd, Archer Daniels Midland.
Present.
Michelle Mapes, Green Plains, Inc.
Present.
Mark McCarg, American Farm Bureau Federation. Aaron Morris, USDA. Dr. Cynthia Nickerson, USDA.
Present.
Edward Prosser, The Schooler Company.
Present.
Michael Ricks, Cargill.
Present.
Bella Rosenberg, International Swaps and Derivatives Association. Derek Salmon, CME Group. Troy Sander, National Cattlemen's Beef Association.
Present.
Liam Smith, Futures Industry Association, Principal Traders Group.
Present.
Stephen Strong, North American Export Grain Association.
Present.
Kurt Strubar, Grain and Feed Association of Illinois.
Present.
Justin Tupper, U.S. Cattlemen's Association.
Present.
Wes Allmeyer, Greenfields Holding.
Present.
Hayden Wands, American Bakers Association. Ryan Weston, American Sugar Alliance.
Present.
Jason Wheeler, USA Rice Federation.
Present.
Last but not least, our guest speakers, Suzanne Sprague, CME.
Present.
Jeff Reardon, White Commercial Corporation.
Present.
Callum Turvey, Cornell University. Seth Meyer, USDA. Thank you. I will now turn it over to Scott.
All right, our first panel today will provide a discussion on futures margining and the impact it has on the agricultural markets. We will hear from Suzanne Sprague with CME, Jeff Reardon with White Commercial Corporation, Joe Barker with the National Council of Farmer Cooperatives. Suzanne, please begin.
Thank you very much. I'd like to thank Chairman Behnam and the commissioners for having me here today. So I'll try to keep it brief, knowing that you're probably tired from yesterday. I thought I'd talk a little bit about our approach to margin settings, as well as how we've managed through periods of increased volatility over the past few years for these markets. And I'll also echo the comments made previously about the importance of these markets to us and globally as well. We take our role as a systemically important clearinghouse very seriously, and we find it very helpful to have discussions with market participants and experts in different fields to be able to ensure that we're taking all factors into account when we set margins. So thank you for the open discussion today and welcome any questions and dialogue associated with the presentation. Just to kick it off, I wanted to remind everyone about the importance of a couple fundamental factors that we use to manage risk. So on slide 2 or slide 6 here for the presentation, just wanted to give a reminder of especially 2 fundamental tools that we use to manage risk every day as a clearinghouse. That's daily mark-to-market, so at least once a day, but for most markets and futures and options especially, we do mark-to-market twice a day, and that really allows us to remove debt obligations from the marketplace on a twice-a-day basis and ensure that those exposures are paid and collected between our clearing members and then downstream their clients every day to ensure there aren't losses building up in the marketplace that could cause bigger issues down the line. Another fundamental risk management tool that we use every day that's very important is what we call performance bond or margins, and that is to protect against losses that are not paid through the mark-to-market process. And that's what I'll focus most of the discussion on today, is how we go about setting margins. So moving to the next slide, CME's margin methodologies are data-driven and based on largely historical information for the markets that we clear and what's happened through different periods of volatility in the past, as well as forward-looking in a sense of taking into account fundamentals or qualitative information that may not be present in historical data. We currently have 2 margin models that we use for futures and options. We're in the process of managing or migrating a new margin model. The margin model that's been in place to date is called SPAN, Standard Portfolio Analysis of Risk. And we're in the process of migrating to an enhanced version of that margin methodology. We call it SPAN 2. So I will talk a little bit about the benefits of the new margin model in subsequent slides, but just wanted to highlight that that transition is underway for us. And we have currently migrated the energy asset class to SPAN 2. We are planning to migrate on an asset class basis over the next couple years. So regardless of margin methodologies, for us, those methodologies are designed to achieve at least a 99% coverage standard at the portfolio levels, ensuring that we have enough funds collected in margin to cover a confidence intervals of 99%. And we do measure that every day. We call that back testing. So every day we look at market moves at both the product level and the portfolio levels for the clearing members that face us directly. And we evaluate what the mark-to-market was on that product and that portfolio compared to the margin that we had coming into the day. And that's how we ensure every day that we meet our coverage standard. So that process, for example, over the 12 months ending third quarter of this year showed that we actually achieved a coverage standard of 99.97% for those futures and options products. We also employ tools to mitigate large changes in margins, knowing that that can cause a liquidity drain on market participants. So we ensure that we have adequate coverage at the product and portfolio levels, but we also use a few mitigating factors to make sure that when volatility is low, margins don't drop artificially low, such that in times of volatility spikes, we would then cause a sudden spike in margins. And slide 7 outlines a few of the factors that we use to smooth out that margin setting process, especially for agricultural products. There are seasonality factors that we take into account. So what has price volatility looked like in a previous winter or a previous spring, depending on the product that we're talking about? We use volatility floors to make sure we're looking over a longer time frame at how low volatility has dropped and making sure that we don't go artificially low in the margin setting process such that a spike in volatility could then cause a sudden requirement for increased liquidity or collateral to support increased margins. So I won't go into very much detail about all of those specifics, but just keeping in mind that the pro-cyclical effect that we can have on the marketplace is critical for us to consider. We know that the actions that we take can impact the broader marketplace, and so we are very cognizant of making sure that we don't cause those sudden liquidity drains on the market in times of increased volatility. I'll also just mention event risk is something we take into account. So whether it's impending weather events or impending geopolitical events, that is information that we take into account in the margin setting process that, again, may not be present in historical data. We're also looking at implied volatility for those markets that have active options traded to get a sense for where the option market might be indicating volatility is going. So moving on to the next slide then, we are focused for all of our margin methodologies and being specific about those fundamentals and market unique conditions that need to be taken into account when setting margins for our various asset classes. So this slide really is just meant to further detail the way that the margin models behave when we look at historical data for a given asset class. We are looking at varying weighted look-back periods, taking into account things like seasonality, longer look-back periods, making sure that we're aware of volatility events that may have happened in the past that could happen again, or not forgetting the past is another way to think about that, while also keeping in mind that volatility changes quite significantly and quickly when different events pose risk to the systems. So regardless of margin methodology for us, we are considering those factors in both the SPAN and the SPAN 2 model. I'll also just mention, it's important to note that the margins that we set are the clearinghouse level margins, and so those are the minimum requirements that we charge of clearing members, and those are the minimum requirements that clearing members need to charge from their clients, but they do have the ability to charge additional margin. So that's something to keep in mind here too, is clearing members can choose to set margin levels higher on different products or portfolios as they see fit. So I have a few examples of recent volatility over the past few years and how that has played out in terms of margin coverage for us. So this chart I know is very busy. It's meant to really depict a few different factors. So the light blue lines that you see going up and down are the profit and loss every day for that corn futures contract in the front month. And then the darker blue line that you see sort of in the middle of the slide is the margin that we've set for that product. And so you can get a sense for our backtesting view of how our margin model performed for this particular contract through periods of increased volatility or increased profit and loss. The green line is also important, so that's the absolute price of the futures contract for corn, because we do see that as prices change significantly, margins need to change to accommodate that as well. And so especially when you think about the volatility changes and the price changes that have happened through the invasion, Russia's invasion of Ukraine, we have seen for a lot of commodity markets, absolute prices go up in these markets, and that also causes margins to increase. So here a couple periods for corn stand out. Obviously the periods around May and July of 2021, you can see spikes that were occurring on the price side and how we were adjusting margins to account for that increased volatility. There were not any breaches in that period of time, but we did come close to the price levels actually starting to increase above margin coverage. And so you'll see that in that period of time, margins remain high until the volatility starts to come down, which is more around the September of 2021 timeframe. So that's really the pattern that we're tracking in addition to margin levels with respect to absolute price levels. So it's a busy slide, but this is meant to give you a picture of what we look at every day. And it is common for market participants to look at these factors as well. So many of our market participants also track the price changes of these markets every day and the absolute prices of these commodities against margin coverage. And that's a dialogue that we engage in on a regular basis with the market. I have just a few more examples I thought that were worth showing in a similar manner. So wheat futures is another example of where we've seen significant price swings over the last few years. The period here of interest mainly is in March of 2022. So you can see a breach actually happening where the price did move above the margin level for a particular day. And so that causes us to evaluate potential margin increases, in which case we did make increases around that time period for this contract. I will note that a breach on its own doesn't necessarily mean margins need to increase. The coverage standard of 99% generally means you should expect 2 or 3 breaches in a year based on the number of trading days. So a breach is not unexpected or a bad thing, but it does cause us to evaluate if volatility will persist and if market conditions have changed for that contract such that we need to increase margins to ensure that we continue achieving that coverage level of 99%. And then the next example that we provide here is rough rice. So again, the time periods are somewhat different in terms of the volatility spikes that we've seen in that contract, but this is another example, especially in early to mid 2020, where we did see a significant change in profit and loss on a daily basis or daily price changes for the contract that caused us to increase requirements around that time frame. And this is an example of where hindsight is 2020. So you will see that those increased margin levels did persist for a longer period of time due to the implied volatility that we were seeing in the marketplace and the number of significant price changes that we saw day over day. So hindsight's 2020, and that looking at the period of volatility that really starts from, let's say, September of 2020 and then goes through 2021, the levels were coming down slowly, and that's a common theme for us as well. We tend to increase margins quickly to make sure we achieve that coverage standard. Again, we try not to make increases in large amounts day over day. We generally step those in over multiple days to make sure we're not causing liquidity pressures or funding pressures on the marketplace. But when we bring them down, it does tend to happen somewhat more slowly as volatility is persisting and potentially decreasing on a slower level too. So this is just an example of where those margin levels did remain higher than price changes for a period of time due to the amount of volatility that we saw in a short period and the implied volatility of the options market. So then the next slide is just, our next few slides actually are just meant to dive a little bit deeper into the new margin methodology that we're migrating to. Span 2, again, is what we call it. The process that we use today to set margins in spans is data-driven, and we use a variety of value at risk models to inform the levels that we set for different products. It's a somewhat more manual process for that reason, where the data analysis happens outside of the model, and we feed those inputs into the model to be able to achieve the portfolio effects in the margin methodology. The benefit of Span 2, really one of the primary benefits, is it's a more automated model. So the data is fed on an automated basis, taking that manual nature out of the margin methodology setting process itself and allowing us to have fewer components that we need to adjust manually if factors are indicating that historical data is not necessarily the only information that we need to be accounting for in setting margins on a forward-looking basis. So the Span 2 margin methodology is more automated, and for that reason, margins at the product level change on a daily basis. It's not necessarily unique to the overall portfolio effect, though, because positions likely change on a daily basis too. So whether you're talking about SPAN or SPAN 2, it is common to have daily changes at the portfolio level to reflect either changes in positions or changes in option value. The SPAN 2 methodology, similar to SPAN, takes into account historical scenarios as well as what we call stress risk, or periods of scenarios where there might be increased volatility, again, used to smooth out the margin setting process and be able to have an anti-procyclical effect on daily changes. So we are still very focused on making sure there aren't sudden changes day over day, even with a more automated model. And then in addition to historical and stress factors, we also take into account the liquidity challenges or concentration factors that might be present in a given product or portfolio to make sure if we had to liquidate that clearing member's portfolio, we would have enough funds to do so even beyond any historical or stress price changes that we've seen in the marketplace. So this is more common where you see, let's say, lower open interest in products. We need to account for the fact that we may incur additional costs if we have liquidation happening in a product with lower open interest or a more concentrated market participant base. And then lastly, I'll just cover on this slide the overall migration schedule. So as I mentioned, we have already migrated most of our energy products to SPAN 2. That completed over a few dates in the August and September timeframe of this year. Our next asset class that we're migrating is equities in the first half of next year. We'll then cover interest rate and FX products next year. And our last asset class will be the agricultural products and any remaining products from the other asset classes that did not migrate under the previous timeline. So our goal is to be fully migrated to this new margin model by the end of 2025. It is important to note that we have active discussions with market participants about the migration process, and so definitely welcome any questions or feedback from this group. Every set of market participants is important to that migration schedule, and so for us, communication is key, and making sure we're accounting for any additional factors specific to those asset classes is very important. So again, we take that migration process very seriously and welcome engagement from you folks as well as we think through migrating for that process. It is very early days for the agricultural markets, but it's never too early to start thinking about what factors might need to be considered. So we are starting to have those discussions about our migration for the agricultural products, even though we're a few years away from that. The last slide I thought I'd talk through just gives you a picture for one of our energy products and how you can think about the difference between SPAN and SPAN 2 margins. They're largely in line. We do see small increases and decreases at portfolio and overall clearing level for those changes, depending on the directionality of the portfolio. But overall, the margins are meant to be similar. So this is an example that we show for the crude contract. The light blue line towards the top and the very bottom represents the SPAN 2 margin model. The darker blue line represents the SPAN margin model, and then the light blue line in the middle is the daily price change for that product. So here you can see that SPAN and SPAN 2 largely track each other in terms of the coverage that's provided by those margin models. The last thing I'll mention is just the importance of transparency. So many of you may be familiar that we post margin levels on our website for the major products and the major asset classes. We'll continue to do that for SPAN 2. We are doing that currently for the energy products. And then we do provide a variety of tools that customers can use to be able to do margin analysis themselves to ensure that for existing portfolios or hypothetical portfolios, there's an understanding of what the margin levels look like for a given product or portfolio. So happy to take any questions about margin setting generally or the migration process, and I'll otherwise turn it over to my colleague. I think you might be up next, right?
Yes, thank you.
Yes.
Thank you very much. Thank you, Commissioner Behnam.
and the entire commission. Swati, you did a great job helping us, and Scott as well. Thank you so much. I work with a company called White Commercial, and our role in the market is to work with commercial hedgers. So that's all we work with is the commercial hedgers. So when the farmers go and deliver their grain, they're going to deliver it to the commercial hedgers that we work with. And specifically, our customer base is on the smaller side of the agricultural industry. So what you're going to find is our larger companies are cooperatives. And so those are farmer-owned organizations. And so their main concern in times of stress, and we're talking about initial margin today, is access to capital. Because they must stay in their hedge positions. And every bank that they work with and throughout the entire industry, the most important thing to those bankers is that we stay hedged. So that's my role at White Commercial. I came on board about 15 years ago when, if you remember, in 2008, the commodities markets were a little bit volatile as well. And that's when I came. I transitioned from the banking industry into White Commercial to help our customers with their banking relationships. And I'm a CPA, so naturally I was helping with the mark-to-market that Suzanne was talking with as well. That's my role, is basically to train the lenders, basically our customers, their lenders, and their accounting partners on this mark-to-market process and help them to access the capital that they need. So if you're talking about a large co-op, to us, it's a small co-op in the marketplace. But the initial margins, if you'll put up the slide, the initial margins, and I'll talk to this, and our slides are exactly opposite from what you just saw. So you're going to see the futures price on the left side and the initial margin on the right. But what our largest customers are, if you go through a town and you see a farmer-owned cooperative, most likely the cooperative is going to have the town name. Okay, so that's a sign that they may be working with White Commercial. And the banks that they work with, believe it or not, it's going to be a banking syndication. So you're going to have Farm Credit is most likely going to be one of the leaders there, and there will be multiple banks that work with them. Now those folks are going to understand, deeply understand the need for the capital. So part of that stress test is going to be this initial margin requirement, which I'll talk to in a second. Now the second tranche of our customer base, well, they're not going to have the town name most likely on their elevator. What they're going to have is their name, right? Because it's an independent, maybe multi-generational company that it's Smith or whoever their name is going to be part of that organization. Now with them, their banking relationship is going to be a little bit different in that it's probably going to be a regional bank. It may be Farm Credit, but it may be a regional bank that they work with. And for a situation like we're looking at, and I'll talk to, is they're, by changing the initial margin requirement, and we're talking about rice now, not corn, beans, and wheat, but for rice, if you're a rice farmer and you're in Arkansas, we changed our initial margin from $750, basically on the right side, all the way up to basically $3,700. So it's a $3,000 change per contract. So for them, they've, like I said, they've got their name on the door. They're probably looking at about $1.5 million, $2 million in initial margin. So this isn't a small amount, to them. And believe me, we need this protection in the market. But you can see how quickly that the protection was needed. So there's a lot of money to anybody, but definitely to our customer base. And finally, the last tranche of our customer is that smaller farmer, and all of them are trying to protect against price risk. And when the market gets volatile, it could be $50,000 to them or $100,000, which is, once again, it's all related to the balance sheet that you have. And in that case, that may keep them out of the market. Right? They may have to go somewhere else other than the futures market if it's going to be, $50,000 or $100,000 to get in. But for our customer base, this is a big move. And like you said earlier, it was almost unprecedented to see a move this big. But the initial margins do affect us. It's money that we have to put in. That's our skin in the game. And so with our customer base as it is, and one of my associates, Jason Wheeler, was with the Rice Federation. He asked me to come and talk to that because I'm intimately involved in the financial structure, for that part of the agricultural community. But that's why we're here, is just to talk about that. And honestly, we had a great conversation with the CME, and they're very open with, their process, and that's something that I'd like to, talk about today in the Q&A. So I'm going to go ahead and pass my time on to Mr. Barker at CHS.
Hello, can you hear me? Can you hear me?
We got you,
Yep.
Joe.
All right, great. Thank you for having a panel on this important topic. I do have a couple comments and then we'll open up for questions. As many of you know, I'm on this committee as a representative of the National Council of Farmer Cooperatives. NCFC members are local, regional, and national farmer cooperatives. Consist of nearly 2,000 farmer-owned cooperatives across the country. That represent the majority of America's 2 million farmers and ranchers around the country. However, I feel it's important I should point out that my main role in the industry is as the director and principal of CHS Hedging, a cooperative-owned FCM that is a clearing member of CME Group and Minneapolis Grain Exchange, and we utilize partner FCM to access most exchanges around the world to clear trades. I'll be wearing both of these hats as I participate in this discussion today. Most agricultural firms, whether those are producers, private businesses, or cooperatives, use futures and options to hedge commodity price risk. This requires them to post a margin requirement to their futures commission merchant. This margin requirement is a performance bond on their commitment to perform on their positions. For most hedgers, this is simply considered a cost of doing business, and it is very natural for all participants to want to keep these costs as low as possible. We should remember, however, the important function that marking positions to market and keeping an account properly funded plays in maintaining the market integrity for all participants. In futures markets, margin is the amount of money that you must deposit to keep on hand with your broker or FCM when you open a futures position. After the positions are established, your positions are marked to market daily, and the account must be kept above the minimum margin requirement. So if the futures positions lose money and the mark-to-market balance in the account drops below the margin requirement, customers are required to send more money back into their account to bring back above this requirement. This is true for both hedgers and speculators, and it ensures integrity in our market exchange-traded markets. FCMs have an obligation to know their customers and to collect this margin and post this margin at the exchange on the customer's behalf. The daily mark-to-market process, combined with active risk management of having customers meet these requirements on our exchange-traded markets for both futures and options. FCM risk departments deal with this day-to-day risk, and they deal with customers who can't meet this. We view this liquidity risk of whether customers can meet their margin as our true canary in the coal mine. Most accounts are open based on financial statements that can be months or old, and so the easy way to know whether a customer has liquidity to finance their positions is whether or not they can perform on their margin requirements. It's important to note that if an FCM has an issue collecting margin from a customer, we still have an obligation at the exchange to maintain these balances. In this way, FCMs serve as a bit of a shock absorber to the system. It's also important to remember that FCMs have capital requirements that ebb and flow with the amount of customer funds we have on deposit. So when margins go up, this causes the amount of customer funds to increase. It also increases our capital requirements. For industry participants, there are alternatives to using futures and options. They come with their own sets of risk and rewards. There are plenty of reasons why market participants may choose a tool other than using futures and options directly. One of the most common, very common, is cash contracts. For agricultural producers, it's very common for them to use cash contracts as their main margining tool, and then wherever they're going to deliver their products has a futures and options account to manage that price risk. This works out great for the grower because they can lock in prices, but they are setting a delivery location and time. The downside of a cash contract is that you have less flexibility than when you do your own hedging yourself. There are also lots of over-the-counter products, everything from a vanilla futures lookalike swap to a structured product that can blend the advantages of futures and options into one product. Some of these OTC products can even be embedded in cash contracts so that the individual grower or whoever the participant is may or may not have to post daily margin because of the requirement of the cash contract for them to actually physically deliver their products. Of course, when you trade an over-the-counter product, you are open to the risk of default of the counterparty on the other side. Of course, the CFTC has taken great steps since Dodd-Frank especially to reduce that risk and utilize things such as swap data reporting. But unfortunately, there are examples from time to time. What I want to point out is in the 175 years since the Chicago Board of Trade was formed in 1848, the process of marking positions to the market and keeping all market participants' accounts properly margined has been refined into the smooth process that we have today. It is important for both market participants, their FCMs, and the clearinghouse to continue to refine this process so that the system works for everyone in the future. Thank you.
Thank you to the panel members for your presentations and remarks. We will now open the floor to questions and comments from members of the committee regarding your presentation. For members virtually in attendance, as a reminder, please use the raise hand feature to ask a question or use the chat. Oh, Jason, sorry.
Yeah, I wanted to thank the commission and everyone for hearing this. We kind of told the rice story. I'm Jason Wheeler with the USA Rice Federation, and we're consists of farmers, merchants, the commercial merchants, and also the millers, the end users of rice. And our contract is pretty thinly traded. We're constantly trying to get better. The risk management that comes along with the futures market is a huge benefit to agriculture, and so we're always trying to get more folks involved in it to manage risk. And like Joe was saying, a lot of small farmers, the way they access the futures market is not through having a futures account. It's selling cash contracts to their local co-op, like Jeff talked about, and then that co-op uses the futures markets. And so what we saw in the rice, which Jeff kind of told that story, and Suzanne, is the initial margins went way up, and so this was kind of the genesis of the Rice Federation wanted to discuss this, and so we really appreciate it. But what happened is initial margin went way up, which it has to. When nobody knew the market was going to be going up, limit up several days. You know, it was a summer shortage, and price went up almost double, and the initial margins went up 5 times. And you know, it's not just a matter of the price; it's a matter of how much limit moves, and we have to protect all the participants. It's a very good system that protects everyone. What we saw was the real issue that came was later, as you can see in some of those charts, the initial margins very responsive on the upside, which it has to be to protect the integrity of everything. But on the downside, it became, you know, Jeff was talking about the amount of money required for these commercials to continue to have hedges, right? And so what happened was we got through that summer, we grew a very big crop, and the volatility was gone. You can see it for several months because we grew a big crop, and now the supply and demand situation was you know, somewhat solved. And what happened was the initial margins took a very long time to come back down, and it became a problem for these commercials, which is the farmers' access to the market, the commercials' access to the market, and with a thin market like we have, they exited, and farmers did not have access. They couldn't sell their new crop because the commercials were tapped out of how much money they have on their credit lines and all that stuff. So it became a problem. And I will say the Rice Federation, we ended up having a call with the CME group later. I wish we'd have done it sooner, right? They were glad to talk with us, and we really appreciated that. And we did have a good conversation of, you know, a lot of the stuff Suzanne said about how they calculate it and why it was still high and everything. But it is a bit of a sliding scale, and they consider different things. They weight different things differently at times of the year for good reasons. So we brought some data to them of maybe we should weight it differently, and it ended up coming down. But there was a several month period where folks in the rice business didn't have as great an opportunity to manage their risk. So, like I said, the CME was extremely responsive with us once we talked to them and continued to bring it down. And so, anyway, so we're appreciative of that and everything that has happened. But we just wanted to tell kind of that story. That's what the Rice Federation asked me to do, is tell that story to you guys of how that works and everybody here, and have the CME talk. And we just want the Rice Federation wants the CME to know how appreciative we are of how they managed that and got us through it. But it took some time. And so what we want to do is, we know that stuff is going to happen again one day. I mean, that's, one day the market's going to go way up again. And we hope to have learned from this. And I know we'll be making that call a lot sooner, right? And they're glad to have it. But so sorry for grandstanding here. I hope it's not too long. So it's question time, right? So my question is, the span 2 that will come, do you, in your view, would that be a probably more responsive algorithm for, if a situation like that happened again, would it have gone differently, or do you know? And that's my question.
Yeah, good question, and thank you for the dialogue. We, as I mentioned before, learn a lot from talking to customers. It's a very important part of our job every day. It's something that you don't get on an automated basis, and so I like to think about that's why we're all here and not robots. It's very important to stay in touch with different market participants and make sure we're having open communication about what we don't see as well. So we appreciate you reaching out to do that and encourage everyone to do that in the future as well. Span 2 is meant to be a more automated model that would be more sensitive to changes on a quicker basis. We do use smoothing effects in that model too. So we, again, don't want to have sudden spikes really in either direction that would be premature to miss volatility that's still present in the marketplace. But it is a more reactive model based on the automated nature. So we would anticipate in a circumstance such as this that it would have been declining more steadily and perhaps more quickly than the manual nature of how we manage the span model today.
Great, and we had Troy Sander raise his hand virtually. So Troy, are you ready to ask your question?
Yes, Troy Sander with National Cattlemen's Beef Association. My question is probably for Ms. Sprague and also for the CFTC folks as well. There's been much talk and speculation about LRPs, livestock risk protection policies, as a cause for increased volatility in the feeder cattle and live cattle futures market. Can you speak to the oversight by CME concerning these products?
So in terms of those cattle products generally, the process would be similar in terms of the information that we take into account for margin setting. There were references to price limits, and many of these products do have limits in place that we are monitoring on a daily basis in terms of how volatility might be reacting to certain policy changes. We generally also take into account for those markets where options are active, that the options can indicate prices moving beyond the limits, and so those can come into play in having margins be higher than the absolute daily limit. But I must admit, I'm not intimately familiar with the specific change that you referenced. I don't know if anybody from the CFTC wanted to cover that as well.
I mean, no specifically, but like we certainly are following the policy changes, certainly at USDA and otherwise, to see what we would need to do. But really, this is more of a commercial decision and changes that would need to be made.
Does that help, or did you want to have a further dialogue just with more background information that I could help with?
No, thank you. I think that helps. Thank you.
Okay.
All right, we had another question from Ed Gallagher.
Good morning, Ed Gallagher with the National Milk Producers Federation and Dairy Farmers of America. Jeff, question for you relative to your work in helping these smaller cooperatives fund their margin accounts and working with farmers. Do you see that as the CME migrates to span 2, an easier ability to fund, a more challenging, or about the same?
It's it's hard for me to say as you move in that direction. From what I'm hearing, I believe that it's going to be easier because what we're looking for, we need access to capital, as you said, and it's talking to the banks. And if we have a little more time to get the money, what needs to be clear, I think, to everybody is that if the money doesn't hit the account the day that this changes, they're forced out of the position. So and we must keep positions as hedgers. So I do believe it's going to work better, but I haven't seen it, so I don't know. My job is to communicate and help educate the bankers and CPAs on what we're actually doing to access that capital. So the more, it sounds like we're gonna have more transparency, so that will make my job easier.
Thank you.
All right, Jerry.
Hey, good morning, and thanks, everybody. I really have more of just some general comments and any questions to anyone, and thanks for the presentations. I represent the Futures Industry Association, but as most of you know, I'm also the CEO of R.J. O'Brien and Associates. Been around a lot longer than I'd like to think, but it's the case that I've been through incredible market swings over the years and have experienced all of the things that folks have spoken about and have been worried about over the years. I do endorse the FIA best practice paper that related to exchange volatility and the control mechanism, which in some part asks the exchanges to keep a higher minimum exchange margin requirement for customers to help offset potential spikes to the upside. Now, when it comes to agriculture, higher margins means higher cost to the farmer and the producer because in some part their operations are, funded by debt. And of course, higher margins means more debt and more cost. So it increases the underlying cost of the agricultural product in some ways. However, it's hard to thread the needle on the risk related to the stress events that occur as an FCM, and Joe has already spoken to this. We become the shock absorber between the customer and the exchange. We meet that margin when the exchange debits our account, and it's up to us to make sure the customers meet their margins. And overwhelmingly, the customers do. It's the difficult times for agricultural producers, probably medium and smaller size ag producers, who I think in the aggregate are very important to the U.S. economy, that get squeezed, that their bankers aren't prepared for these types of up moves. And it takes them time to get their lines extended and opened. And this is when experienced FCMs like CHS, RJO, others in the ag space understand this and can work with bankers and provide some time. So it's a very delicate balance in this industry between having higher margins that protect the exchange, the system, reduce liquidity crunch during high periods of volatility, but don't hurt the U.S. farmer that has to provide the food for the nation, and in some cases, the world. So those are just comments to absorb. I'm happy to talk to anybody on the side. Jeff and White Commercial is one of the top firms in the industry. They know their business and they do it well. And what I reinforce what Jeff has been saying is those hedges can't be blown out. FCMs have a very responsible obligation to work with their customers to protect those positions in the times when the bankers are making decisions to extend the lines and provide more liquidity to the farmers. As far as SPAN 2 goes, I also have a lot of experience with that. RJO as a clearing firm has now implemented SPAN 2 in the energy segment. We think it's a better product. I think how it's gonna perform in volatile periods of time is there's plenty of models that say it's going to be fine, but we'd like to see what happens with it. One of the comments we're getting back on SPAN 2 is since it does have daily changes in margins, customers are perplexed by this. I didn't change my position overnight, but now I'm on a margin call. And that is taking some adjustment for customers to come to grips with that. Now, Suzanne, you mentioned that it's not, I don't know, I don't want to put words in your mouth, but you referred to, positions change daily and things like that. And so customers are used to daily changes in margins. Not always. A hedger has a position on, might have a position on for 3 months, but the margin requirement's changing every day. So it's a change of behavior for the customer and their bank to become familiar with that. overall, and in time, when everyone becomes accustomed to it, I think it will make the market safer. So it's not meant to be critical of SPAN 2, but there's going to be adjustments that the farmer and their bankers are going to have to become accustomed to. And those are my comments. I hope you find them productive, and I'm happy to take any questions as well.
Are there any further questions from committee members? Mr.
Thanks, Scott. Ryan Weston, American Sugar Alliance. And I just want to note, I really appreciate it. It's so important, the integrity of the system. Our particular industry, we do not have a lot of margin products on crop insurance revenue side. So the raw sugar market is very important to us. And I just would say a lot of the prices, the input prices we're dealing with have been much stickier, I think, than most of us thought. The fertilizers, the fuels, labor, these things are staying really high. And so these future prices that we're falling back on, if it's the cash price, it's the cooperatives, they're about as important as they've ever been. And, there has to be tweaks all along the way. And, our individual farmers, they do have to work because we have to turn the cane or the beets into sugar to have a product. So the ability to hedge and for it to be efficient is really important. We're running into the problems, weather. There's a huge drought in Texas, and even Louisiana was impacted. All of these things, as you're looking at these markets, they're not huge in the grand scheme of things, but they're very huge to us. Mexico owes the United States 700,000 acre-feet of water in Texas. That's a State Department issue. It's nothing that the commission can deal with, but these are huge issues for us. And these things need to be done because it affects sugar, it affects cotton down there, a little bit of rice, citrus, all these other things. So I just want to say we know how hard the commission works with all the regulated entities. We know how hard the exchanges work. These things are vitally important. They're cost efficient. You can count on them. It's one of the only things we have in our industry, and we have to use derivative of the raw to figure out what to actually pay for our refined, because we don't have a refined market contract in the United States. So I just wanted to thank you all that I know these conversations, they usually only happen when things are going really badly and everybody's mad. So I like that the conversation's happening right now as we're looking at it. I appreciate it.
Mr. Strubhar.
Thank you. Thanks to the commission and the panelists. That's a valuable topic. Question I had is more oriented on timing of margin. And, our standard practice in the commercial hedging industry is T+1, right? This morning we were making margin calls for yesterday's activity or sending excess based on yesterday's. In volatile times, like the March of 2022 instance that you brought up, the FCMs that we work with tend to have a policy of an intraday margin call if a certain level of margin is breached, be that $1 million, $5 million, at the commercial hedging level. And that intraday margin call could be the opposite direction to a margin move that had already been made T+1 for yesterday's activity. And it can get a bit onerous. And I guess my question, whether it's SPAN 2 or any other initiatives, it seems the ideal scenario would be to get to a T0 margining policy as a general practice anyway. But there's a challenge, with a 1:15 market close and a 3 p.m. banking cutoff for the same day. And I guess kind of open-ended, can you speak at all towards any initiative to get to a T0 margining policy as a regular practice?
Yeah, it's a good question, and there's a lot of talk in the industry about enhancements to technology that provide real-time capabilities. And we do look at those technologies from a few different applications. I think the thing to keep in mind, though, is we like to think about on-demand capabilities more than real-time capabilities because markets move, constantly. And so I don't think we need to get to a place where wires are going back and forth on a real-time basis. We all have our own investment accounts. I can't imagine your 401k account getting hit several hundred times a day with wires because markets were moving throughout the day. So we are very thoughtful when we consider enhancements that might benefit the industry, and we want to take into account the chain reaction that our actions or migration might have. And so I think we've heard a lot of discussion here about the complexities of the actual end user and multiple players in the chains that provide very important roles and functions. And in many ways, those are funding functions, but that places stress and then the drain on a different set of market participants. So it gets tricky to think about. We certainly, as a clearinghouse, manage a T0 process for the intraday cycle, and it's quite a tight timeline. So the clearing members have about an hour to meet the intraday cycle for us for both mark-to-market and margin. And banks play a very important role in that process too. But we are cognizant that the way that money moves throughout the chain isn't necessarily set up to be a T0 process today. And we do hear from different market participants, farmers, for example, who are harvesting during the day and not capable of meeting real-time or more T0 requirements. So what that really would mean is more money put up in advance, which can place a different level of stress on the marketplace. If you have more pre-funding, somebody else just pays for it at some point in time is the struggle. So we are hopeful that technology advancements can help the entire chain at some point in time, but it gets tricky to think about the right solution and all of the changes that would happen as a result of that to who the funding requirement shifts to and their ability to manage that. So it's a great question and important to think about. Having the dialogue with a group of folks like this is part of the process and very important to us. So we're always open to doing things differently and better if you see an opportunity, and aware that there are different types of technology that different institutions are considering using that may facilitate better movement of value and faster movement of value, but that money comes from somewhere, and so that funding risk shifts accordingly, and we're not we're not agnostic to that because we understand that that can place additional pressures on a different part of the system.
Mr. Barker, did you still want to ask a question?
Was just going to comment on that as far as market access goes. The larger entities that we work with, whether those are cooperatives or private businesses, can easily meet an intraday margin call in almost every case. But as we think about the individual grower or individual market participants as a whole, we need to be thoughtful if we were to change to a T+0. Of course, they're expected to, but like we said, the FCM serves as a bit of a shock absorber. And so at times we have to meet margin calls by 11 a.m., for example. Those wires may not come in until 3, and that's just that's what residual interest is used for on an FCM level. And so I just think we should be thoughtful before we would make some sort of change like that.
Thank you. Do we have any questions or comments from any of the commissioners?
I have a quick question, and this might be pretty basic, but going back to the slide that Mr. Reardon had up, if you were to overlay the slide that CME's margin calls, I mean, does that exactly match up? And I guess my question is, the initial margin that you showed in that slide, is that all the margin model from the clearinghouse, or is that also another layer of initial margin that might be coming directly, that might be part of what the FCM is requesting? This is just a question I struggle with a lot is, when an end user is putting up initial margin, who's setting that price? Because I think there might be, sometimes there's maybe a disconnect that it's not always what the clearinghouse is charging. It might be a different calculation based on, the FCM, as Joe explained, being the shock absorber here. So I'm just curious, when you look at that slide, if that initial margin is based on CME's initial margin in that contract, or if it's adding in additional calculations from the FCM.
It's exactly what the CME margin is, and it's just set up, on a different side.
Thank you. That's
You're
helpful.
welcome. Thank you.
All right, for our second presentation today, we will now hear from Professor Callum Turvey with Cornell University. And I'd like to give a special thanks to Alan Martinez with Cornell, who is not on the agenda but was instrumental in setting this up. Professor Turvey, please begin.
Thank you very much. Is my slideshow going to be through your screen, or am I going to just use my own sharing?
So we've got it. We can advance for you.
Okay, good. So this work, as you can see by the title, from the academic side, I was teaching futures and options. I teach the undergraduate futures and options class at Cornell University. And the war broke out in February of 2022, and I had to explain to my students what was going on with wheat markets. We then followed that through, and I put a master's student on it to really try to find out what was going on in this due to war. There was no literature on what the impact of war and conflict is on futures prices. And here we had a very unique situation where we saw an immediate reaction with wheat futures prices, but there are also two other contracts. There's the Black Sea contract, futures contract, which is generally Russian ported wheat, cash settled. And then there's a Ukrainian futures contract, which is Ukrainian ports, cash settled. At the time of the war outbreak, I'm trying to explain these markets. You know, is it going to be a long war or short war? Why has the market gone up by 33% from $8 to around $11 prices of wheat? And explaining that in such times, people have to guess. Were they going to take Kiev in 3 days or 4 days, or was it going to be a prolonged war? The political risks, market risk, trade risk, financial risks, currency risks, all of these things have forces which are going to affect these futures contracts, even though they are all in US dollar denominations. Next slide, please. So we started looking at this complex between the CME futures prices, Ukrainian wheat futures prices, and Black Sea wheat futures prices. We had to recognize, in order to understand what's going on here, that we just couldn't think about this as an exogenous shock that's going to be short run, and students, hedgers can trade on it on a very simple basis. The wheat markets are globally linked through spatial trade relationships, as well as local supply and demand conditions and shipping costs. What was the relationships and the information flow between the futures prices before the war? How were these three markets co-integrated with each other? How did they move together? What are the patterns or the directional flows of influence between these markets? And what I mean by that is, does the supply conditions and demand conditions in Ukraine affect the wheat prices in Chicago, or are the wheat prices in Chicago determining what the local prices are at Ukrainian ports, and so on? And so we had this sort of very complex structure where, as the war broke out, there had to be readjustments in the global wheat supply and the trading economy. And the big question is, how did these relationships change as the result of the war? And this question had come up with the trade war on soybean prices, with the Chinese blockade on that period. And what we had found then was, as the blockade increased, there was a complete disconnect between the Chicago price and the Dalian price of soybeans. And we wanted to see whether or not we can make some determination here also as to what this particular conflict would have on these prices. Next slide, please. The only paper we really found on this was one by Holbrook Working, and you might know Holbrook Working as sort of the father of storage economics when it comes to futures prices on that. And he wrote in 1941 warning individuals and scholars who might be looking at the impact of the war on prices to sit back, and you can't just look at what's happening to the prices instantaneous and contemporaneously with the news events of the day. that you have to look at it in the context of what was going on in global markets before the war and then during the war. For example, we were just coming out of COVID. There were still supply chain problems bringing supplies into the United States. There were still marketing problems and so on to do that. And so there were changes in terms of the patterns of demand and supply in importing countries. With the high prices of wheat, countries that normally would import would then use their own stocks and draw down their own stocks rather than pay the higher price, which was shifting the demand nature of wheat from these countries as well. There are also countries that have different inelasticities. If you're looking at North Africa, African countries that have no domestic supply of wheat or very limited supplies of wheat, the necessity of wheat would suggest that their demand is going to be much more highly inelastic. So the price shock in those countries would be much more significant. So all of these things we thought we'd better sort of take a look at in this very rare circumstance of conflict. Next slide, please. So Ukrainian agriculture, just it is a very large wheat growing area in Europe. The breadbasket of Europe, some have called it before. Most of Ukrainian land is arable, and agriculture provides about 14% of Ukraine's population. And it's also a very important exporter. Now, the global exporters are not huge relative to, say, the United States and Canada, but in the markets that it does export to, it's a very significant player in the world market. Next, please. Here is the study period. So this is from bar chart. And you can see that the three prices, the black is the Chicago, the orange is the Black Sea wheat price, and the blue is the Ukrainian wheat prices. And we were interested in these movements before the war and then during the active war period. And you can see there's two lines, the study period and the pre-war period. We ended at the 2-year anniversary of the war, the 1-year anniversary in 2023. But then there's an epilogue in the paper, if you want to take a look at that, where again, things changed again with a different sort of dynamic between these three futures prices from that. So our study, where we're looking at these causalities and these relationships, is really to where the second vertical line is at. We did not study beyond that, and beyond that, of course, there were differences and changes in the field as well. Next slide, please. These next few slides are just illustrating sort of what the markets were thinking. Here's a March 7th title. Wheat prices soared to trigger trading halt for 5th straight day, surging nearly 50% since that. From a teaching point of view, of course, I was able to then illustrate what a trading halt was. It's a rare thing. We don't see that very often and don't often quote it. Next slide, please. Here is what the outlook at. So again, this is 2022. Everybody's trying to second guess what's going to happen on the ground. The beginning of the war saw troop movements from Belarus and from the Kharkiv area towards Kyiv, right? And then that shifted to the south and the east, which changed the dynamics of the war, heading right into the higher wheat growing areas. Next slide, please. Also, throughout this time, we cannot forget about what's happening in the Black Sea and the blockade of the Black Sea. So these are two things that become very, very important in terms of trying to understand the prices. And now all we can really look at in terms of causality is the event analysis, when these events took place, and try to break it down into sort of discrete moments in time where there were major events, not just small battlefield events, but major trade events that would do that. But there's two things. One is the blockade in the Black Sea and the flow of wheat from Ukrainian ports to destinations. But the other one came when insurers decided that they're not going to insure any freight going through the Black Sea, which is going to have a huge impact on the transportation costs, particularly when the futures contracts, Ukrainian and Black Sea futures contracts, are cash settled and shipments are free on board. Then what happens to those costs and who pays those costs starts affecting what that freight market looks like, and so on. Next slide, please. And here is the food security. Swati asked me to sort of mention this a little bit, although it's not too much. But there were some serious concerns about importing countries, particularly North Africa and Africa, which had strong dependency on Ukrainian wheat. And also, as I said, perhaps a higher or more inelastic demand, so that the prices were really quite severely affected there. But even within the combat zone within Ukraine, the seeded acres would be reduced, port elevators were destroyed, rising costs of inputs such as nitrogen, migration as people fled the battle zones, the theft of agricultural equipment, destroyed source facilities, and of course the blockade itself. All of these things affecting agricultural productivity into 2022, 2023, and perhaps 2024. Next slide, please. Right? So trying to understand the economics in war is not just a very simple, oh, a war broke out and the prices of wheat went up and then the prices of wheat went down. Commodities are global and markets tend to adjust to conflicts. And we saw quite a bit of that. We saw Canada and the United States beef up and start releasing supply. President Biden said you can replace land in conservation if you were to plant it to wheat, right? The global markets moved in order to increase the supply to export Ukrainian export markets that would be in short supply to try to stave off some of the food security concerns that can do that. There's also multiple commodity effects, and we only looked at the wheat complex, but of course, naturally, natural gas, oil, and things like that also were impacted, as well as other export crops from Ukraine and Russia. And so we did have these changes in global supply because of the blockades, because of supply in the conflict zones, and of course, the trade effects of supply and demand response. Next slide, please. So here's sort of a quick chronology of some major events that we looked at or we were considering as we were looking through these. So the first period you can see, and these are the basis. So this is the difference between the Chicago price and the Ukrainian landed price, all in common units. From that, you can see that the prices before the war, they were sort of moving together from that. Then as the war broke out, then we saw huge basis changes between the three different contracts, or the two Baltic or Black Sea contracts and the CME. Okay. We then had the blockade, the period at which Turkey started negotiating the Black Sea Agreement. Then we see the Black Sea Agreement at line C, and then the renewal in November of 2022, the renewal in 2023, and then July 17th, which was after our study period, you can see again the impacts when the Black Sea Agreement was canceled, which then again put risk into the shipment of freight through the Black Sea and Turkey. Next slide, please. Here is the Ukrainian wheat production. If you look at the map, I can't point it out because I don't have control, but the main battle zone right now in Lugansk, Donetsk, down through Kherson and Kharkiv area. So the battle moved from the Kiev area down to this heavily grown wheat area. And that's where the battle lines are drawn, just along the border lines, really, of Donetsk, Kharkiv, and so on. Next slide, please. Here are 4 slides, and I do apologize for them being dark. This is provided by One Soil, which looks at satellite imagery on a field basis, and they were kind enough to provide me these these graphs because I wanted to get an idea of what was happening on the ground between 2020, 2021, 2022, and 2023. And you can see the top two are 2020. You're looking at the lighted areas there. Those are the areas which are planted to wheat at the field level. In 2022, you don't see a lot of difference, only because it was mostly winter wheat. And so it was still in the ground, even as the battle goes. And then in the bottom right, you can see where the effect is. You can see that that brightness has now disappeared. And you can almost see on from the lower right through the Kherson area, you can see almost blacking out as farmers abandoned those fields, or the fields were mined, or the fields were bombed and no longer arable for the wheat production. And you can just sort of see that black line which goes along the border from Donetsk through Kherson in the east and the south, which is where the battle lines are drawn and where the battle lines are to this date, affecting and splitting the two wheat markets. But even to the north of the battle lines, you can see that quite a few of the lands have been apparently abandoned to wheat. So again, here's the impact of war on domestic supply. Next slide, please. So the effects of supply restrictions increases price in trading countries, increases domestic demand prices, and decreased domestic supply trade. All of these things have feedback loops into the three futures contracts form that. The effect of the Black Sea blockade from an economic, it increases the prices of importing countries, reducing export demand, increases the supply in Ukraine, reducing Ukrainian prices, and increases the domestic demand in Ukraine with lower prices. So there are domestic and external dampening effects. The transportation costs, which I think are probably the most important in terms of these prices, that the transportation costs rise with the risk and insurability. And once they remove the insurance, then of course the risks have to be borne by the shippers. And then that's going to increase the cost. And seeing as there's no way to transfer that into world markets and world prices, then those prices and risks have to be borne by the Ukrainian warehouses and shippers, putting lower pressure on the FOB price in Ukraine. So all of these things are affecting what the prices are going to be. Next slide, please. What we did, and I certainly can't go through all of the regressions that we ran, but we ran what we call vector autoregression or co-integration analysis for multiple periods throughout the war. We looked at it from a base starting 6 weeks or March 2021, and then just extended our analysis to see, as we added on 6-month periods, how did the price change as the war hit in February 2022 and then throughout February 2023. So just elongating that period and seeing on average, how did it change? Then we also looked at how these price relationships were in 6-month increments, starting in March to November of 2022, April to December, and so on, as we led up to the war. So we can see what the more impactful or the more closer to the war, how were prices affected. And what we were looking for were the changes in the causal relationships and the statistical relationships between the three futures contracts. Again, the paper has many, many regressions, so I'm just going to provide a quick overview because I'm probably running out of time as it is. Next slide, please. So here's a picture of the correlations between the prices. On the left are the level prices. And you can see that the correlations about 84, 82, 95 between the three contracts when looked at the levels prices, that is US dollars per bushel. You can see that in the war period, February 24th to February 28th, 2023, those prices sort of moved together. The period, the post-war study, which also included the abandonment of the Black Sea Agreement, you can see then a huge breakdown in the correlation in prices, almost as if the Black Sea and the Ukrainian futures prices were moving independently of the CME prices. Look at on the right-hand side, are looking at the percentage changes. So these are capturing these local effects on that. And again, you can see what the effect is, that there are things, even though the general price movements are there are things that affect the prices change. So if there's a price change in Ukraine and a price change in Chicago or a price change in Russia, it doesn't mean they're the same effect, right? The general movements are there, but there's also other things affecting those markets. But look at the third one down in that post-study area where the correlations in the price relationships absolutely completely collapsed. So in this period, we just saw no relationship between the three prices. And then it sort of returned once there was stability brought back into the Black Sea era. Next slide, please. So here's sort of what we found. We found that pre-war, we saw that Black Sea wheat, that is wheat originating from Russian ports, really had a strong influence on Ukrainian wheat prices, right? So Ukrainian wheat prices mostly followed Black Sea wheat prices. Ukrainian wheat prices also followed the Chicago wheat prices. But we also saw that the Chicago wheat markets also followed the Black Sea wheat prices, right? So in terms of those markets in the global price in Chicago, the Black Sea ports were more influential than the Ukrainian ports. At war, January 2022, leading up to the war, Ukrainian wheat causally influenced. Now you can see the direction of flow. Chicago traders got really worried about what was happening in Ukraine. And as Ukraine prices changed, these were strongly influencing in that direction the Chicago markets. Chicago wheat still influenced the Black Sea wheat price. Causality by July 2022, so we know that the war is going to last a longer time. The causality between the Black Sea wheat and Ukrainian wheat fractured altogether. There were really two different markets. Russian ports were obviously not blockaded, but Ukrainian ports were blockaded. So that signaling between those two markets collapsed. Then the Black Sea Grain Deal Initiative in July 2022, again, what was happening in wheat was driving what was happening with the Russian wheat at Russian ports. So people were focusing more on supply effects and what was happening in Ukraine than Russia. Chicago wheat also influenced the Ukrainian wheat, and that's because of the global markets as they adjusted, expansion of supply, a good bumper harvest in the Americas, and so on. And the Ukrainian wheat causally influenced Chicago wheat. So again, the Chicago markets really paying attention to what was happening domestically and with trade in Ukraine. Now, our tables in the paper, of course, have many more of these. I'm being very, very general just to illustrate how these global effects affects futures prices from a trading and a hedging position. Next slide, please. So just some concluding thoughts on this. Obviously, the Russians' invasion of Ukraine was a major disruption on the world wheat futures market, a very rare event, the largest war in Europe since the Second World War, to study it. The presence of the CME Ukrainian wheat futures prices provide a rare opportunity to look at the relationship between war and commodities. The pre-war causality pattern we just discussed was Black Sea wheat was a strong influence on the market. Ukrainian wheat was more of a follower rather than a leader, but that reversed as time went on. And of course, there are shifting dynamics continually. The war today is not the same war it was a month ago. It's not the same war it was a year ago. And all of these things are going to affect the prices depending on what's going on the ground. What our results show is that the markets are paying attention to those things as well. And yes, of course, exogenous shocks such as these are going to have profound and global effects. And last slide, please. So I hope you can be a little bit forgiving in terms of the story I'm telling. We were not able to find any papers that perhaps could guide us perhaps better on our approach to doing this. Our thought process was to look at it from the trade models, from importing countries, We set up a trade model which had Ukraine being invaded by Ukraine, and then a third-party country which was exporting from Ukraine. And we used that to sort of guide our thinking and then see how events happened according to what the trade model predicted. We have not put this paper through peer review. And I don't think we will, only because it is so dynamically changing that by the time it gets published, the story will be completely changed on that. But it is available. I have sent it to Swati, and it is available on SSRN if you are interested in more details of what we've done. If I've gone over my time, I apologize. But I'll be happy to take any questions.
Thank you, Professor Turvey, for your presentation. I'd now like to open the floor for questions and discussion regarding your presentation. We will begin with questions and comments from the members of the committee. Okay. So seeing none, oh, sorry, we see. Oh, sorry. Keep on
Thank you, Scott.
And
if I may just take one moment and go off topic, I'm going to have to pivot to virtual after the break. So I wanted to thank you, Chairman, for your personal leadership of this committee. There's a great network occurring here of stakeholders, and to be back in person here sharing our experiences in these markets is really important. So thank you for that. And I would be remiss not, and by the way, I'm Buddy Allen with American Cotton Shippers Association, but I would be remiss not to flag your recent guidance on voluntary carbon markets and just applaud the Commission for the leadership in that space. Many of the companies that I represent are investing in products to add value to agriculture and stakeholders through regen, sustainability, and all practices of the like. We need definition and certainty in those markets and those products so that they can be authenticated and that value can increase for agricultural stakeholders. You are at the tip of the spear, and I applaud you for that. I hope the broader administration and Congress will continue to focus on this emerging market because it's critically important. So I know that's off topic from Ukraine, but I wanted to say it while I was here, and thank you all.
Seeing no more virtual hands or tent cards, do we have any questions or comments from the chairman or any of the commissioners? Okay. So turn it back to you. Or do we have time for a break? Okay, now turning it back to Swati.
Okay, thank you, Scott. At this time, the AAC will take a 15-minute break. For participants joining us virtually, please make sure your Zoom is on mute and turn off your video during the breaks to expedite our return. We will return at 11 a.m. to begin our third panel. Thank you. I'd like to now call the AAC meeting back to order and return the agenda to Scott.
All right, for our third presentation today, we will now hear from Seth Meyer with the USDA. Seth, if you're ready, please go ahead.
All right, thank you very much. I am mentally shifting gears. I appreciate the staff of CFTC giving me a room across the hall where I was just running a seminar on global oilseed markets. So we'll try to cover a lot of ground here in this because I think you have broad interest here amongst different agricultural commodities, crops and livestock, overall farm economy. So we'll try and cover quite a bit of ground in this short amount of time. But any questions, all questions welcome. First slide. I want to throw this up here. I don't expect you to read the entire list, but the Office of the Chief Economist does include the World Agricultural Outlook Board that does global supply and demand balances for crops, but we do a lot of other things, some of which I have understood came up earlier in the discussion today. I'm also the head of the Federal Crop Insurance Corporation Board of Directors. Things like that. And all of these things are of importance to us and things we deal with in the Office of the Chief Economist, most of which I'm not going to talk about today because I'm going to talk about Outlook. All right, so let's go into the next slide. I use this a lot if you have heard me talk before because I remind folks that prices started to increase all the way back in late 2000, a lot of that being driven by improved trade in agriculture, being also driven by corn and soybeans initially, with wheat being dragged along until we have war in the Black Sea, wheat showing its, obviously wheat showing its strength as a result. And we've seen prices moderate and continue to moderate since the spike of the war. So we still have prices elevated, but they've certainly come down significantly from the highs we experienced back in 2002. Next slide. But this is where I start to draw, some of your experts in the room may draw different conclusions. We saw a lot of, this is implied volatility. 2002 is implied volatility, and the gray area is implied volatility ranges for the previous 10 years. And then you have 2022 and 2023. So what you can see across corn, wheat, and soybeans, a tremendous amount of market volatility in 2022 during the onset of the war. And there is seasonality to these. And so the war was also a very counter-seasonal increase in volatility, a shock which is not a normal shock we see in increases in volatility. But when you turn forward into 2023, what you notice is those volatility measures coming down quite a bit. And I think one thing I would contrast is when we start to separate out corn and soybeans and maybe think about those as being primarily feed from wheat and even rice, you get a little bit of a different picture where soybeans and corn volatility has declined. The market feels more comfortable with those. It feels less comfortable in markets like wheat and rice globally. Next slide. And part of that reason here is where we think about, now this is updated again, the folks at USDA put out the WASDE report each month, and this is the one produced last Friday, which starts to talk about what do global carryout stocks, what do we have left over at the end of the next marketing year? And it's that same kind of split where you see corn and soybeans, things more closely associated with feed, showing growing stocks, where we have rice and wheat showing perhaps tighter global stocks. And I think it's just important for us to talk about this from a global food security standpoint, given what we've gone through in the last 3 years, even as we dig into more market specifics. Next slide. So I think when I describe this last crop season, I think one of the things I do admit, when somebody asked me, what surprised you about the last crop year? I think part of what surprised me is farmers' flexibility in deciding what they were going to change acres into this past year. They got a signal that says produce more corn, produce more wheat, both crops that the Ukraine was producing as well. They came in, they produced those crops. Forage conditions had been poor. They produced more hay acreage, and as a consequence, they produced or planted less soybean and cotton area as a result. So I show this because the farmers showed a pretty good amount of flexibility this year in terms of crop mix. The signals were there. The USDA asks them, what are you going to plant? The market gets to respond, and then the farmers get to change their minds a little bit based upon what the market tells them. So there's a signal early on that this is a process perhaps unique in the United States. What are you going to plant? USDA reports on what those farmers say. It allows the opportunity for the market to signal back and say, can't I convince you to plant a little bit more of this crop? So you can have market reaction. Next slide. So another thing that you've probably heard a lot about here, and that I think does continue to have some influence on our global market, is that we've gone from a 3-year La Nina, and here's kind of typical patterns of La Nina, and let's move forward to the next one, to an El Nino, to a strong El Nino. And what you'll notice about this is, when I think about an El Nino, it isn't so much that it has large effects on total crop production that are certain. It changes where those crops are good or bad for the most part. Rice being one of the ones that is a bit unique. And I know we're not talking about things which are heavily traded on our markets yet. We'll get there. But one of the things is rice tends to be concentrated more geographically, and so El Nino can have an effect. But again, I think one can identify El Nino effects going on in several markets around the world. Next slide. And again, one of the other challenging features, as now we're going to jump in and start talking about individual crops, is it was a less than ideal year across the United States when it comes to growing conditions. Okay, so it was very hot at certain periods. Some folks got timely rain, others didn't. But less than ideal conditions in much of the corn and soybean and even wheat growing areas across the United States, and including pasture and forage areas important to livestock production. Next slide. And we had some really extreme temperatures during critical development phases for the U.S. crop this year. When one thinks about 104 to 112 Fahrenheit, anything above 35 Celsius while the corn is in pollination stage is not a good thing if it's an extended period of time. So when you look at this, you say, with those dry conditions and with this heat, what kind of crop do you expect? Next slide. And yet we had pretty darn good yields. Not, again, below trend, but the other thing I find surprising about the crop year, and we'll look at soybeans and some other yields as well too, is that the crops seem to fare well despite what is maybe less than ideal weather conditions. Crops seem to fare fairly well. So you have here a yield which is slightly below trend, but because of farmers' response and saying the market wants corn, we're going to produce corn, you had large corn area. Even with that yield, we have record large U.S. corn production in the United States this year. Record large. Next slide. As a result, we will be stocking it here in the United States. And that softening prices, you know, we got corn stocks in exporting countries. You see us as the red bar. Low prices expect to spur global demand. We hope we are the ones that are carrying additional stocks into the end of the year on our increases. So that's about a 50% increase in our year-over-year carry-out stocks. Next slide. Let's talk real quick about Brazilian soybean production, just because I came over from this meeting just moments ago. Again, here, we made some adjustments just this last month on the size of our soybean crop in Brazil. Pretty early for us to do that normally, but it's been rather dry. There are basically two zones, and I'm going to talk a lot about Brazil because Brazil is incredibly important now for how we think about, and has been, for how we think about global soybean markets. Next slide. When you compare those two zones, you have an area in the south which basically gets an even amount of rain all year long, and you've got the area up by Mato Grosso, which has a more seasonal pattern of rain. You expect that rainfall to come on. It's been less than average and hasn't really come on strong within that region of Mato Grosso. And as a result, go forward one slide. We've got areas of significant soybean production where you talk about there up in Mato Grosso that are having less favorable conditions for soybean production. So we've already gone in at this point and said that will temper our expectations about soybean production in Mato Grosso, whereas in the south, rainfall is very good, and it looks like the crop there, you've got maybe too much rain, but you got a lot of rain in the south and where production looks good. Now, normally here in an El Nino situation, it would be the northern edge of Mato Grosso and north, which might be dry with an El Nino condition. So it's not inconsistent with that, but I'm not sure I'd lay it all on an El Nino condition in the precipitation we're seeing now. Next slide. But it also it isn't just that it has been dry there, it has been exceptionally warm in Mato Grosso as well too. We didn't see great rain last year in some of these regions either, but we had much cooler temperatures. The combination is we've got hot temperatures this year with that less than ideal rainfall, which is at least at the moment causing that crop to suffer. Next slide. But it's still going to be a big crop under normal weather assumptions going forward. And so you got Brazil area yield and production numbers. That is still a lot of soybean production year over year as the world looks forward as what are you going to do with all those soybeans? Think about also a rebound in Argentina, a rebound in Paraguay. Again, will we see that rebound in Argentina, et cetera? They suffered last year from one of their worst conditions. They usually import some soybeans for their crush system, but they imported about 10 million metric tons last year. They just simply didn't have a crop. Next slide. So again, we'll continue to watch that Mato Grosso soybean production and the subsequent corn. So as those beans are being harvested, right after that comes the corn production on its tail. So that will tell us what we will watch next. And again, soybean production in Brazil fundamentally changed how we view carry in the futures market in the United States. And soybeans, I think corn will increasingly see that change in carry. The dynamic and timing is a bit different, but it's going to grow that same way and change our market. It comes off a few months before our own harvest. Next slide. So that's the kind of punchline when it comes to overall soybean production at a global level. This is what we expect in terms of South American production, increases in South American production, a falling U.S. share. So, one of our challenges is we're facing a lot of export competition for our soybeans into the rest of the market. China, obviously, being 60% of global trade in soybean, 60% share of global soybean trade. We will naturally see our U.S. trade share fall. That's a natural, but we'll have to look for what are some alternatives to export demand. Next slide. So let's think about it again. I wanted to show this one and say, beans are much more flexible than corn in terms of weather at specific times of the growing period can have negative effects on corn that corn can't rebound from. Beans, a little bit more flexible, and yet I'd say less than ideal growing conditions throughout the entire year. But still, again, yields not that much below trend despite challenging production conditions. Next slide. But the difference, we talk about what is going on in the U.S. market for soybeans when you've got that big overhand in South America. One of the things that has helped offset that has been U.S. crush demand. U.S. crush demand being driven by domestic and state-level policies on biofuel production, specifically renewable diesel in California, and the RFS has significantly changed the oil value of a bean. So you think about oil share of the bean crushed makes two products. Most of the weight is in meal. But now 40% of the value is in the oil, and it's only less than 20% of the overall physical volume, but yet now it's 40% of the value, and it has been elevated relative to history. Crush demand has been strong. Oil demand has been strong. We are importing things like used cooking oil. We are importing things like canola oil from Canada, and it's being driven by this demand for products. So when you hear some policies, biofuel policies about expanding feedstocks, et cetera, this is part of what is driving this. This market is being driven by domestic policy for renewable diesel. And again, I'm kind of throwing some teasers out there. You all can ask any questions you want, either now or when we get to that point. But again, it is nice to have domestic demand when you're facing such large foreign competition in this regard. Okay, next slide. And this is that futures crush margin where, even though it's come down quite a bit, that crush margin is basically what can I make by taking that bean and crushing it and selling the oil and the meal. And the crush margin's coming down. We have been fortunate. Again, I remind you, we have two products. We have meal and we have oil. And for meal, we were fortunate that the Argentines had a bad crop and we could put our meal into the global market. How long does that last if Argentina rebounds, has a good campaign? They're the world's largest meal exporters. They want to come into the market and export more meal. What are we going to do with our meal, and how is that going to affect our domestic crush margin when we want the oil? So again, I think there's a lot here at play. Maybe I'm just trying to push my thesis of feed volatility falling and food volatility rising. Maybe I'm just trying to push my thesis, but I think even within the bean, maybe we see a little bit of this split. Next slide. So I'm just going to reinforce my thesis again here, saying we've got global carryout stocks of corn and bean rising and rice and wheat stocks contracting a little bit. Next slide. So let's talk a little bit about those commodities as well too. Wheat, again, this is perhaps a different kind of outlook than I usually give because I'm going all over the world talking about specific things. Happy to talk about U.S. balance sheets at any point, but I think it's important for us to talk about some of these global drivers as well too. Ukraine, we talk about the end of the Black Sea Grain Initiative, but there we're talking about now an expectation of nearly 39 million metric tons of exports of primary commodities out of Ukraine. This does not include things like sunflower oil, which perhaps we've seen some improvement in the exchange of sunflower oil relative to the seed itself, but that's about 3.5 million metric tons a month. That's not bad, and that I would have to admit that the solidarity lanes overland have performed better than I would have expected early on. okay? And yes, we do not have a Black Sea grain initiative. And I think that again, maybe I'm just pushing my hypothesis again about food grains versus feed grains. Well, let's go to the next slide. When one thinks about this, I think part of the reason we maintain volatility within the wheat market around the world, despite the fact that we've got big crops, is where those big crops are growing as well too, or at least one of the places where those big crops are growing, which is Russia has had 2 very big crops in a row. And if you listen to the chatter, has a 3rd big crop on its way. And when you look at this, I think the market takes both concern, and we see volatility when ports in Ukraine get hit, but we also saw volatility when a Russian oil ship got hit. So I think this is a reminder that, you know, the U.S. pushed very clearly that sanctions on food, we don't have sanctions on food. Food is different, and that's been, I think, a clear message, and I think this reinforces it. We do, in fact, need the Russian wheat in the global wheat market, and that volatility remains, at least in part, because folks are concerned about this. So the Black Sea Grain Initiative served and would serve the purpose of saying food is different. Next slide. And it just gives me an opportunity to talk about rice as well, too, and some of the volatility that we've seen in rice prices as well, too. This is the only table, I think, in my whole presentation, and I just show it because we cut Indian exports of rice, 6.5 million metric tons. Why does that matter? This is a pretty thinly traded market. And secondly, India supports its domestic production of rice. And we can talk about, hey, in a food insecure country, do you want to support a staple crop? We can talk about that. But the other side of that is when they feel nervous, they put export controls on. So you are both pushing your excess supplies into the global market on a regular basis, but then when the world might be able to use those extra supplies, you put export controls on. So you're introducing, this is a message about being a reliable supplier, right? So you can't push your surplus onto the global market, and then when you feel a little nervous, cut the world market off from your supplies, because all you're doing is pushing all that volatility onto the most vulnerable consumers around the world. So this has been a contributing factor, so from why we saw rice prices start to rise, and you have other countries which tend to react and have reacted in the past. When we've seen really big runs on global rice prices, it has been as a result of other countries following suit in export controls, and it just pushes all that volatility into the global market. Again, noting who's importing India's rice? African countries. Some of them have been able to continue to get it. It hasn't been a complete ban. But again, this is a bit of a story about where is some of the volatility coming from and being a reliable supplier. Next slide. Let's talk quickly about cattle markets. I could talk about cattle markets a lot. I like to talk about cattle markets. We're in a contraction phase of the cattle market right now. This is part of the reason, as we talk about this, why you've seen beef prices rising. Okay, we're in a contraction phase. The herd is getting smaller. We go through these cyclical periods, and part of this is the biological lags, the price signals, and the amount of time it takes to turn this market. So we're in a contraction phase, and I know you all know that we have seen recently record high feeder and fed cattle prices. We've seen record highs for both. We've come off of them pretty significantly, but they're still elevated. And I will tell you, I think there are fundamental reasons for that. Even though we're in a contraction phase, you say, we're in a contraction phase, why are feeder cattle and fed cattle prices falling? And I would say, we have a January cattle report coming up from USDA. And the question will be, do we have a few more calves than we thought? Or are we just taking this coasting plane on a declining cattle herd and turning it sharply into the ground? What do I mean by that? I mean, we've got feeder cattle. Folks are trying to decide whether they want to hold those calves, breed those calves, raise those heifers, breed them, and produce new calves, or cash in now. Because of forage conditions, because of other signals, because of high prices, folks have decided they want to take the money now. And so what we've seen is placements, animals on feed, kind of build up the supply of animals on feed. And so that's the fundamental that is in the short run pushing down those animal prices. But what you're doing is you're taking away your potential and you're putting it into the processing market. So you're forcing yourself at a sharper downward trajectory in cattle prices. So as we think about food price inflation, as we think about beef prices, even if you made a decision, even if we, which I don't necessarily expect, we see a cattle turn in the spring, you still got a couple years before those things become that, before that makes a new steak. So you got a couple years left of contracting beef supplies in the United States. Okay, next slide. And again, a driver of this for the last couple years has been poor forage conditions. Here's where the cattle are at and where the drought conditions are at overlaid against each other. We have seen the drought moving from the high plains, perhaps more towards Nebraska, but it's still, and hay production improved this year over last year, but that's not saying a lot. So folks with cow-calf operations west of the Mississippi saying, can I maintain those cow-calf pairs with the forage conditions I got? Or should I just cash in the money now and send that feeder to the feedlot? And right now they're saying send it to the feedlot. Next slide. Alternatively, in swine here, when we think about the health of the overall swine industry, I'm going to talk to you a little bit about some obscure details here that matters. Profitability in the swine industry has been poor. And so the natural reaction by producers is to say, we will pull back a little bit on supply. The natural reaction, right? We're not making money. Let's pull back a little bit on the number of animals we are breeding. And they have. The offset, perhaps unexpected, at least by me, offset has been a sharp increase in the number of pigs per litter. As a matter of fact, such a sharp increase that it completely offset the declines in farrowing. So while they might have wanted to get less animals by breeding less, the number of pigs per litter increased sharply and completely offset any ideas that they would like to contract the size of that herd. Next slide. At least part of that has been lower pig disease pressures seasonally than we observed in the past. If I added the most recent data from today onto that, we might see it coming back up a little bit, as it does in the wintertime, but we have seen less than full disease pressure, and we have also seen a mix of states improve their overall pigs per litter that are maybe outside of the I states, let's call them. So we've seen improvements in pigs per litter. If that continues and folks want to cut supply, they'll have to make bigger farrowing changes year over year than they had previously. So again, here we're looking at in terms of pork production, we're talking about more than they wanted to, perhaps less favorable overall profitability conditions. Next slide. Let's talk just a little bit about trade. I'm going to talk a little bit about trade and farm income, and then we can discuss whatever you want to talk about. This is the latest trade report from USDA. I think there's about, I don't know, do you want to be an optimist and read this slide? Do you want to be a pessimist and read this slide? I think there's numerous ways that you can look at this slide. I could look at this slide and say the last 4 years have been the best for export and imports for U.S. agriculture in history, right? Some folks might say that, say, hey, you're developing a pretty big gap there between exports and imports. And in fact, that's true. It is we've got a trade deficit for agricultural trade. As a kid that grew up in Iowa in the wintertime, what I could get at Hy-Vee at the grocery store was pretty limited in the wintertime, right? Maybe some sad-looking lettuce. Now, you can walk into Hy-Vee in Iowa and you can get whatever you want. Part of that is a function of improved trade. So part of that is a function of us importing products that we're not producing at that particular time of the year. Some of it's high-value products for consumers, things like tequila, things like that. And alternatively, at this point, some of it's importing calves from Mexico because we don't have enough calves ourselves. So again, trade does serve a useful purpose. And when I look at this, I say, it doesn't have to be, we don't always have to have a surplus. I'd like a surplus, okay? But I don't think it has to be that. I think we can look at this and say, last 4 years have been good for agricultural trade. And I will say on the export side, those last 4 years are part of what's contributed to what we'll talk about next, which is farm income. Next slide. We're not going to talk about farm income yet, but I'll remind you, this is kind of more of that story, which is China came into our market. That's what boosted farm income early. China's demand from us and the overall prices of the commodities that China buys from us have been pushing their share down. But we've had good, solid increases that have maintained from Mexico and Canada to the point where those three are awful close in trade. Mexico, Canada, and China. Next slide. And I'm going to be a little bit self-serving here a little bit and talk about, just as a reminder, about outstanding sales. And this is a bit of a selfish thing because I have an interest in talking to you all at CFTC about this issue. We report outstanding sales. When a sale occurs in the market, when an exporter sells a product into the global market, they have to report that to USDA. And so when I think about this, this is on volume terms. So again, I think part of our trade challenge this year is both volume and value for some of our bulk commodities. And that's just what I wanted to talk about from that slide. Next slide. So this again is one of the final slides from the briefing that we give to the Secretary at the end of every WASD report. And I think the thing to notice from this is that every major agricultural commodity price is lower year over year. And I think we need to start thinking about, and I think this kind of raises the question of where do you see them going next year, right? And from a producer standpoint, you know, what does that look like? You know, 2020, let's go to the next slide. Because this is the other side of it, is not just what I get for my receipts, it's what it cost me to get there. So when one looks at the costs of production, this is one of our measures. So this is expenditures on inputs. And when you look through this, you can see the dashed line says things which were more expensive this year or things which were less expensive, or spending, aggregate spending above and below. And so when you look at this, your eyes come and say, well, things like pesticides, fuel and oil, and fertilizer are low. But those are still not back to levels of 3 years ago. They're still elevated, particularly I would say things like fertilizer. So producers are seeing some pullback in those components, but when you look at the rest of the components, things like interest expenses, et cetera, you can see those expenses rising. So when you look at overall aggregate spending on these expenses, actually up slightly year over year. Okay, so you got falling receipts and increasing costs. Next slide. But overall, farm income in the last 3 years has been the highest 3 years in a row of any time in my lifetime. And if one looks at the net cash farm income line in here, it's the highest 3 on record. So you got 3 really good years of farm income that put the farm sector in a very good position going forward. The question is are costs sticky and are output prices coming down? And does that cause some margin issues for producers as we go forward? Next slide. This is my last slide, and I'm happy to answer any and all questions. We've got a lot of usual suspects here as well, too. Producers' concerns about the next crop. You know, as soon as they go into the field, they're thinking about the costs for the next crop. Growing global competition. I was just on that oilseed discussion. You got big crops of oilseeds around the world. Rebound in Argentina. China now buying corn from Brazil, whereas they didn't before. Lots of those issues. We've got other issues that seem to linger. We've got Mississippi River issues, Panama Canal, which will only get worse in the short run. We got continued poor rangeland for cattle. Again, are we going to see that turn, or are we not going to see that turn? Currently reduced disease pressure. Some of the issues we saw in things like egg prices, we didn't see HPAI the same year, which gave us that pressure on eggs. At the moment, we've seen reduced swine pressure on swine. Is that something that stays around? We've got other things we are working on that could have influence in the market. We've got Prop 12, which is the animal welfare rule in California that comes into force on January 1st. And if you think about how long it takes you to, and the restriction is on the sow. If you think about how long it takes, if the restriction is on the sow, to make the bacon that's available January 1st, that decision was way back in April. So the supplies that will be available in California on January 1st were determined back in April of this year. So whatever we got, that's Prop 12 compliant is what we got on January 1st. So these are other kinds of things which come into play, and obviously ongoing issues with the RFS, sustainable aviation fuel and biofuel policies. I know there was a lot there, and I didn't go into any particular piece in great detail, but I'm happy to answer any questions that you all might have.
Thank you, Seth, for the presentation. I'd now like to open the floor for questions and discussion regarding the presentation. We will begin with questions and comments from the members of the committee. I'm not seeing any in the room, but are there any virtual hands raised or on the telephone? Nope, okay. Do we have any questions from the chairman or Commissioner Mersinger?
Seth, thanks for being here. We value the partnership with USDA. We know we work a lot with you, certainly on the econ side, but you know, whatever we can provide on the market side, we hope it's valuable. The farm income statistic was interesting, and like, how do you bridge the gap? And maybe I'm not appreciating commodity prices as they relate to sort of the farm income side of things, but given the higher costs, how are we maintaining that level of farm income despite sort of the externalities that seem to suggest we would not necessarily be hitting records?
Yeah, so I think you're probably pointing to 2022 where we had record farm income despite all of the chatter about input prices. And there aren't farmers in the room, I don't think. Maybe we've got some farmers in the room here, but I usually tell the story and the farmers usually laugh because they know it's true, which is usually if you talk about inputs and you ask a farmer about inputs, they'll say, I can't get fertilizer. The part they usually leave off is, I can't get fertilizer. The part they leave off is, at a price I want to pay, right? That's the part they usually are silent on, and they laugh about that. In 2022, it was truly the case. They were concerned about ability to get it. So I say that because I think 2022 turned out to be a good year simply because commodity prices were so strong, even relative to inputs, but it wasn't without a lot of stress. So what I'm saying is there was a lot of stress in it, a lot of chatter. Yes, they paid more for inputs. Some of it they had already secured before the war started in 2022, right? They had already purchased some ahead, and so they are able to smooth it out. But on the end of commodity prices being so strong, it did turn out to be a good farm income year. And farm income at the national level does mask certain things, right?
And a second question, if you don't mind, on the Brazil front and sort of where that market's going, what impact that has on our producers and exports and sales to China. And then maybe a little bit of a longer curve analysis on where you see that going, and then maybe juxtaposed against like biofuel consumption and where is that heading, and whether or not that's going to pick up the slack and maybe lower sales of beans and corns to China because of our Brazil.
So I'll ask the easiest one. I'll answer the easiest part of that question first, is where do I see Brazilian production going? Up, bigger, larger, more. I think that one's pretty straightforward. I think if one were to look back and look at how the growth in Brazil affected U.S. soybean production and the way we think about carry, I think there is a third pillar to that, which is China. You got one destination in the world, which is 60% of the market, and buys year-round. Okay, so I think that fundamentally changed this system of soybean supply where we've got 6 months. It's just-in-time delivery. 6 months for the United States, 6 months for Brazil. 6 months in the United States, 6 months in Brazil. Demand in China growing more than 4% a year annually. I'm not sure I see that continuing going forward, right? So, but the Brazilians don't have necessarily a reason to take their foot off the gas at the same time. And so I think if we're focusing on soybeans first, we've got domestic demand, which is fortunate that we have that domestic demand given the global competition on the bean side for crush demand in the United States that's serving the renewable diesel program, serving the RFS program. I think if we continue to expand crush, though, when you crush the soybean, you don't just get the oil, you get the meal. So we're going to have to think increasingly about where that's going to go. So I think we'll continue to see a need to find markets from that. So I think from that point on, it gets very complicated. Brazil exports beans. Argentina exports products. So we're facing competition from Brazil for the bean side, so we crush them domestically for our oilseed program, and now we're competing with the Argentinians on the meal side. So we're going to continue to face competition from South America. On the corn side, I think we have some more natural advantages, perhaps. But here, too, the Brazilians got a lot of land that they can plant second crop corn on. They can plant corn right behind beans. They can grow that area. The Chinese, looking to diversify where they're getting their supplies from, increasingly have looked to Brazil. They used to have phytosanitary controls on imports from Brazil. They removed them. And so now you've got a big competitor from Brazil into the Chinese market.
Thanks, Seth.
Yeah, thank you. That was a great presentation. Just a quick question, going back to the slide on the trade, and where we're starting to see this deficit. I want to make sure I was reading that correctly, but that was all of our agriculture commodity that we're trading.
It's the in value terms, right? Because we're exporting different things. It's not fair to a ton of this and a ton of that.
Right,
yeah.
Right, exactly. And as you mentioned, the lettuce and Hy-Vee, we didn't have Hy-Vees in South Dakota, but yes, we did not. There was no fresh fruit and vegetables in the grocery store in the winters when I grew up. It was a lot of canned goods, and so I totally understand what you're saying. But to that point, is this just going to be the trend going forward, that we're going to have a growing trade deficit for agriculture commodities? And how much of this is driven by, let's say, China deciding that they're going to, source a lot of soybeans out of Brazil, and kind of geopolitical factors that play into that as well?
No, I think it's a great question, because, again, I think you look at that graph, and it depends on how you want to view this. You can view it many different ways. And I think if you took a longer-term view, you would say this cross may have been coming, right? And so I think it is a continuing challenge that we're going to have to face in U.S. agriculture if we want to kind of get back to something more balanced, or maintain something more balanced. I think having the more you have your trade concentrated in one destination, the more you rely on continued demand from that destination. The more you concentrate on specific products, the more demand, the more you are sensitive to the demand of those specific products. We always see much more volatility in our export values than we do our import values. And maybe that's the resiliency of the U.S. consumer in terms of what they want to buy. So I think here's where I put my U.S. ag enthusiast hat on. We need to convince other countries of the value of our agricultural commodities, and need to have that same response to them. So I think we need to figure out ways to gain access to markets and sell them the commodities we're good at, and figure out how to expand that. Because otherwise, I think we do face the real challenge that becomes not only permanent, but continues to widen if we don't exploit that. What is that? Is it selling more pork into Mexico, or is it new things? I was just down in Mexico trying to, and somebody threw it, what should we sell the Mexicans? I don't know. Maybe we need to convince them that they like apple pie as much as we like guacamole at the Super Bowl, right? You got to find some market to high value to sell it to them. And I think that there are opportunities. We need to figure out how we're going to do that. Otherwise, we'll be locked in.
Thank you. No, that's a great explanation, and really appreciate that.
All right, before we move on, I'd like to give members an opportunity to raise any suggestions for discussion topics for the 2024 meetings. Mr. Coyle.
Sure. I'm not sure if this is maybe a topic for our next meeting, but just a topic that the National Grain and Feed is sensitive to, and wants to make the commission aware of some of the banking proposals that have been announced. We talked about margining and the cost and impact that is associated with that on our hedgers, and much of our industry is, and our members are hedgers. You know, the FCM industry has been one that's been consolidating. We're seeing fewer and fewer options for those services. You know, many of the major banks that are still operating as FCMs, we see these proposals potentially significantly increasing their capital requirements for activity related to futures trading and these services that they're providing as FCMs. So there's some concern that this trend that we've been seeing in terms of a reduction in FCMs, that we could see further reduction, which could eventually, we could get to a point where there may not be sufficient services or providers for those, and or their costs the cost for that business, they may charge more and more, which, you know, will affect all users, but may impact the smaller users that are more sensitive to some of those costs. So, you know, hedging for farmers from their production, but also end users, the cost of their inputs is important and a critical part of our industry. So, just something we wanted to share and make sure you know that, and I'm sure you are, but it's a point to raise from the NGFA. But otherwise, you know. Very much appreciate you hosting and bringing us all together. The presentations so far today have been quite informative, and I really appreciate being here.
Thanks, Mr. Barker.
So I had two ideas. One was brought up today, and I thought it was a good idea. We could possibly discuss the intersection of how these insurance products, like the livestock revenue coverage and farm programs, intersect with our agriculture exchange traded markets. And I think you have an ability to bring in speakers that can speak very, very good on this. So I think that could be a really good topic. It was brought up earlier today. And then I guess the other one I thought that could be a great service to the industry would be kind of a high-level update on sustainability programs that the CFTC is working on in conjunction with other committees that are actually happening. Some sort of update for how that's going to impact our agricultural markets, or some sort of high-level update could be quite a service to the market participants as a whole.
All right. Any other thoughts? Oh, sorry. Ed.
Thanks, Scott. I listened with great interest to Suzanne's comments today around new technologies and techniques, data manipulation that they're using for market oversight. And I wonder, as I was listening, if those technologies could also be used for market transparency. The idea that from an end user's perspective, knowing who's buying, who's selling, the quantities that those are happening at, and more real time than obviously the reports that we get today. And having the exchange explain maybe the opportunities to use those same tools, only not just for market reg, but for market transparency, I think might be very interesting.
All right, I'll turn it back over to Swati.
Thanks, Scott. We will now hear from Chairman Behnam, the AAC sponsor, for his closing remarks.
Swati, thank you. Scott, thank you. Seth, thank you for presenting. And to all the members for being here. Again, it means a lot to us. I know holidays are around the corner, but making the trip out. It's been a great year. We've had a lot of great meetings. Ed, you mentioned the first panel. I was very intentional in having that panel. I've talked a lot about our markets. You know, my colleagues have too, being accessible, being priced appropriately so end users can put on a hedge and keep a hedge. Obviously, a lot of volatility in the markets. I think there's a lot of questions, a lot we learn from CME, but these are going to be, you know, issues and discussions I think we need to continue having into 2024. AgCon, Kansas City, Ed apparently is going to get everyone to come, but we would all love to see you there. It's going to be a great event. And I think let's just use, again, after the holidays, an opportunity to think about what discussions and topics we want to talk about. We will hopefully make the advisory committee a part of that 2-day event, but the Ag Conference itself is going to be unique and separate. And we're going to try to get folks from USDA to come down and other federal agencies to speak about a variety of topics that are important. But it'll be good, like I said at the beginning, to be at a DC and getting together in that environment. So I want to thank Commissioner Mercinger for being here and adding her expertise and experience and being a part of the morning. And again, thanks to Swati and Scott and everyone who participated. Wishing you all a very happy, safe holiday, safe travels, and we'll see you in 2024. Thanks.
Thank you, Chairman Behnam. Thank you to all the AAC members and the guest panelists for your participation in today's meeting. The meeting is now adjourned.